Have you noticed the stock market bouncing back? Have you seen Bitcoin soaring past $100,000 and gold pushing near all-time highs? It's not a mystery. The money printing cycle is already underway. That's the real reason behind the surge. The money supply has just hit a new all-time high. We're officially in the Great Meltup. Just look at the charts. Holding cash for too long right now is risky. That's why when Trump's tariffs shook the markets, I said, buy the dip. Because this is a rigged game powered by money printing and inflation. Now, let me address something I always see in the comments. And I know I'll see it here too. But Warren Buffett is hoarding cash. Okay, but let's be real. You're not Warren Buffett. You're not out here buying billion-dollar companies with that cash. His playbook isn't your playbook. And just a heads up, God forbid we fall into a deep recession, you know exactly what's going to happen. They're going to crank up the money printer even harder, printing at an exponential rate to bail out everything: the bond market, the banks, commercial real estate, and anything else that's making the wealthy lose money. So look, the best-case scenario here is that we just keep printing money at this pace, with the money supply growing at around 6.3% per year. Okay, but the more likely scenario is that something breaks in the system, forcing massive money printing and rapid expansion of the money supply. That would cause financial asset prices to skyrocket, and eventually, that asset inflation will spill over into consumer price inflation. So even in the best-case scenario, we're in trouble. But the more probable outcome is that we're in even bigger trouble, and it's coming faster than most people expect. Look, here's the reality. The market isn't as strong as it looks. The PE ratio is stretched, the economy is slowing, the labor market is weakening, and interest rates are still relatively high. Yet the stock market keeps climbing. Why? Because the money supply is expanding and has just hit a record high. But we need to talk about more than just that, like market dips and the real impact of consumer inflation. So I don't want you walking away from this without a clear, solid understanding of what's really happening. My goal is for you to be able to explain this entire situation confidently to your friends, your family, your coworkers, anyone. Now, let's start with the M2 money supply. Think of M2 as all the liquid money people can easily access. This includes cash, checking account balances, which make up M1, plus savings accounts, money market accounts, and small-time deposits like CDs. Why does M2 matter? Because it shows how much money is actively circulating in the economy. And that has a huge impact on everything from inflation to asset prices. Okay, that's a great question. How does the M2 money supply actually increase? In simple terms, how do more money get into the system? One way is through the Federal Reserve. When the Fed buys government bonds, it injects cash into the banking system. Banks then have more money on hand, which they can lend out to consumers and businesses. Another way is through lending itself. When banks issue new loans, they're effectively creating money. This is why people say money is loaned into existence. Even though it's borrowed, it still adds to the total money circulating in the economy. But let's step away from the technical stuff for a moment. At the end of the day, more money is being created, and that money has to go somewhere. And right now, it's flowing straight into financial assets. All right? Now, I want to point something out. This right here was the phase when they got serious about fighting inflation and tried tightening the monetary system. But if you look closely, that tightening cycle is already over. I'm just saying, it's time to wake up and recognize what's really happening. Here's what's really happening. The new monetary expansion cycle has already started. While rate cuts grab most of the attention as a sign of easier monetary policy, there are multiple factors involved. Even though rate cuts have been paused, monetary expansion is still underway. What's driving this? The Federal Reserve has shifted away from aggressive tightening. Their quantitative tightening, once $25 billion a month, is now down to $5 billion and will soon hit zero. After that, they'll switch to quantitative easing. It's just a matter of time. This is a key piece of the puzzle, and I want to explain it clearly because a lot of people hear about easing but don't really understand what it means. So this is an example, this is a big example. Now let's talk about the anticipated easing of the SLR, supplementary leverage ratio, for U.S. Treasuries this summer. Honestly, in my view, This is a clear sign of desperation. We've covered this many times. The US government has a massive amount of debt coming due this year, and they need to refinance it. But the big question is, who's going to buy all these treasuries? It's not going to be foreign governments. Their buying activity has been weak, and it's not picking up. If the Fed steps in and starts buying treasuries to fill the gap, that would be an unmistakable sign of distress. And they want to avoid that. So instead, they're looking to ease the SLR rule. Currently, banks are required to hold capital against all assets they own, including treasuries. By relaxing this rule, it encourages banks to buy more treasuries without taking on additional capital requirements. In short, they're trying to create new demand because they need more buyers. And yes, this is happening alongside an uptick in bank lending. Lending rose 2% in Q4 2024 and another 2% in Q1 2025. That tells us there's still room for further expansion based on banks' current credit utilization. Now, I want to highlight two very important concepts. The first one isn't surprising. It's well established. When the money supply expands, it tends to support higher asset valuations. Why? Because increased liquidity means there's more money circulating in the system, which naturally drives up prices, including the prices of financial assets. But here's the key point. Not all M2 expansion flows directly into the real economy. The money doesn't spread evenly. A large portion can end up concentrated in financial markets. That's why we often see asset prices soar, even when consumer inflation remains relatively tame. So what's the takeaway? The lesson is simple. An expanding money supply doesn't just impact consumer prices. It can create massive inflation in asset prices, even if it's not immediately obvious on the surface. Here's the real lesson. When asset prices fall, don't panic, because chances are they're just going to print more money. That's why I say, buy the dip. Let's use the stock market as an example. This chart shows how much the S&P 500 has dropped from its highs over the past 18 years. Every time it hits a 10% correction or a 20% bear market zone, those have historically been great opportunities to dollar-cost average or even invest more aggressively. Why? Because what usually follows is a V-shaped recovery, fueled by, you guessed it, more money printing. And let's be honest, the wealthy know this. They've been playing this game since the global financial crisis in 2008. It's the same playbook every time. Too big to fail. The solution? Throw more money at the problem, inflate the system, and push asset prices higher. It's their go-to move. A one-trick pony, but it keeps working. All right. Now that you understand the bigger picture, here's something critical to keep in mind. The Federal Reserve is trying to delay cutting interest rates. And you might be thinking, it's just a small 0.25% cut. What's the big deal? But actually, it is a big deal. Here's why. When the money supply is rapidly expanding, even a modest rate cut becomes far more powerful. That combination can trigger explosive market rallies. Cutting rates in a shrinking money supply environment is one thing, but cutting rates while the money supply is at record highs? That's an entirely different story. And let's be real. This expansion cycle is likely just getting started. So, here's the deal. Powell and the Federal Reserve have been trying to delay rate cuts for as long as they can. And that's likely because Powell understands the risks tied to accelerating M2 growth and the potential it has to trigger major consumer price inflation. Or at least, let's hope he does. But the market's not buying the delay much longer. According to the CME FedWatch tool, there's currently a 76.3% probability that the Fed will cut rates at their September 17th meeting. Of course, there's still time between now and then, and things can change. But I'll keep you posted as this continues to develop. But let's be honest. We all know that money printing, inflation, and the ongoing expansion of the money supply ultimately lead to one thing: the US dollar losing its purchasing power. Right? And the US dollar has had a historically bad year in 2025, and the rapidly expanding M2 money supply isn't helping. Now add the prospect of interest rate cuts, and the pressure on the dollar only gets worse. It's not a good setup. Treasuries and the dollar are supposed to be the world's reserve assets, symbols of confidence and stability. But with all this money printing and monetary expansion, that confidence is fading. Not just for us, but for foreign investors too. That's why I've been buying gold. And yes, I've already made a video about silver, but A gold one is coming next. This is also why I keep buying the dip whenever the S&P 500 enters correction or bear market territory. We're printing more, inflating more, and watching this melt up spiral into something even more extreme. And honestly, it's getting out of hand. Okay, now I just wanted to give you this quick update so you're fully informed about what's really happening. If you're looking at the stock market and thinking, is it about to crash? What's going on? Here's the truth. The market isn't up because the economy is booming. It's up because we're printing a record amount of money. And if this money supply expansion continues, then yes, there's a very real possibility the S&P 500 could surge to new all-time highs. That's absolutely on the table. But don't think it's going to be a straight lineup. There's still going to be volatility. Ups and downs are part of the game. And when the market does correct, you already know my approach. I'm buying the dip. It's pretty straightforward in my opinion. That's it for today. If you found this helpful, make sure to subscribe and tap the bell icon so you don't miss the next update. Thank you.